I'm Kyle Malnati, your host of the Calibrate Real Estate Podcast. At Calibrate, we exist to help people create generational wealth through real estate. My personal mission is to encourage, empower, and educate you by sharing best practices from business leaders that are proven winners. Welcome, Calibrate crew. This is your gracious host, Kyle Malnati, and today our guest is Jeff Bemis. Jeff is business partners with our past guest. Last episode, we had John Hilly on the podcast. Jeff, welcome to the Calibrate Real Estate Podcast.
Kyle, it's my pleasure to be here, and thanks for having me.
For a quick intro, you're a California guy, went to USC, worked for Ernst & Young as a CPA before heading to the hedge fund world, which is one of the coolest parts of finance that I think everybody sort of aspires to go to. So you joined Rimrock Capital Management and managed a hedge fund with $4 billion of assets under management. You did that for 15 years before starting the company that you co-founded with John, and that's 1031 Specialists. That website, 1031specialists.com, and the phone number for anybody that wants to call in and talk with the specialist there is 631-438-1031. We'll put that in the show notes as well. Jeff, thanks for being my guest today. The first thing that we'll talk about that is different from the podcast that we did with your partner, John, is this somewhat new concept of 721 exchanges. The 1031 exchange, I think, is the most broadly discussed piece, but as people are doing more Delaware statutory trust investments, 721 exchanges have become a nuance in the tax code that I think are important to talk about. And we have not spoken about 721 exchanges yet in detail on this podcast. So I'm excited to dive into that topic with you today, amongst other things.
All right. Well, I'm thrilled to be here, ready to talk about any of the topics you want to discuss. And yeah, we can get right into it.
So the journey that I typically see as a real estate broker is I have a client that's used to having a big old ring of keys on their keychain. They're typically a residential landlord or a multifamily landlord. They've been doing things as maybe a mom and pop type of investment for 20, 30 years. They get to a point where they're tired of the T's of real estate: tenants, trash. We don't see this much in Colorado, but California, termites, toilets overflowing, all the T's that people just don't love. And they say, I want to sell. And we used to do 1031 exchanges into single tenant, triple net assets. That used to be sort of the common pathway. This white paper that came about, and one of our most downloaded podcasts is with one of the regional folks with Inland. So we've talked about DFTs, and Inland's a company that a lot of my clients have used. So what ends up happening is instead of doing one singular asset, they decide to invest in a private placement, sort of in air quotes, mutual fund for real estate, which is called a DST. And they're getting a much better product from a construction standpoint, Class A. It's probably a product they could never buy on their own because of the size of these hospitals or Amazon distribution centers or 500-unit apartment buildings.
Totally.
And that property does well over 5 years, and then all of a sudden a client comes to you saying, I heard I need to do a 721 exchange. So let's talk about that, Jeff. What is a 721 exchange? Maybe how does it differ from the 1031, and what type of guidance are you typically giving clientele in that example?
Sure. So yeah, I appreciate that lead in, Kyle, and a lot going on there, right? I'm sure you talked with your guests from Inland all about the benefits of DSTs. DSTs have come a long way. I've been around DSTs for quite a while. They a number of years ago, it got totally and completely blessed by the IRS as a mechanism to use 1031 money, right? Meaning you can tax defer real estate into these trusts and own membership units in a trust. So become a fractional member, a fractional owner of a very large property versus owning your own real estate. My family has owned real estate. My mom has owned her own rental properties, feels this exact same dynamic. DSTs, also there's TIC syndication deals, tenant in common deals that have similar dynamics where I can be a small investor in a big deal, professionally managed, larger deals, more diversified deals, And so yeah, there's a lot of benefits and dynamics there. Sort of typical trade-offs are you don't control your own timelines anymore because you're in a deal. So I'm sure you worked through all of that. It's a very interesting product, DSTs, and it's a very well utilized product, particularly for folks who are evolving in how they want to be managing and active in their real estate. And I think it serves a great purpose, right? And so we see it a lot with our clients, right? So our business is a qualified intermediary of 1031 exchanges is our core business. And so often we're seeing it's particularly well suited if I were to generalize. I mean, it can serve a lot of different investor types, but particularly well suited for a more aging cohort, meaning they're getting later in their life, want to just get passive income, want professional management, and sort of see the benefits there. There's also benefits we'll talk about in a minute on the 721 of later in life as you get into these other products where it's easier to exit these deals and get liquidity and get a step up in basis when it ultimately passes to your heirs. So these alternatives have been fantastic. So again, we see a lot of clients selling duplex, single family rental. Maybe they have a small apartment complex, maybe buying one piece of property and then also buying a DST for half of the proceeds each, and sort of diversifying, buying their book, rotating their book. A lot of folks, we have a strong presence nationally, but have a particularly strong presence in Southern California. And so we see folks who will do DSTs in other markets. It's an easier way for them to play there versus, if they're sitting in Southern California. So a lot of good reasons why folks are utilizing those. As far as the 721, this is an opportunity for folks who really want to get big diversification in particular. The most common use case of this is so in a 1031 exchange, some of your audience may be familiar with something called a real estate investment trust. So there are large pools of capital housed inside of a corporate structure for shorthand, they're called REITs, R-E-I-T. And so these real estate investment trusts, they'll own lots of properties. Okay, so they'll own a big portfolio, and those could range, from any size. It could be a $20 million REIT all the way to, really tens and tens, if not hundreds of billions in singular REITs. Blackstone in particular has one called the B REIT that's, you know, well over 100 billion bucks. So you've got these large pools, and guess what? So inside of these REITs, what's nice? Investors may like to go invest with extremely professional management, very institutional styled firms, and would like to get the big diversification. I, as an investor, let's say I wanted to sell my property. Let's go back to a tangible example. I want to sell my individual property. I own this duplex in Los Angeles, California. And I have that, and I go, man, you know what I really want? Let's say it's worth 4 million bucks, and I'm just going to make up the idea or the number. I'd love to have a very, very small fractional ownership in 150 properties. And I'd love, and again, all these REITs can be orchestrated differently. So this is just an example. But I don't want to be tied to a singular specific property. I want to have and a way to go do that. DSTs in their most typical form are a singular property. Now there's some big DSTs that have a big, it could be a 250 unit multifamily project that's big, or it could be relatively small, but it's generally one piece of real estate. So the idea is, oh, I'd love to be with 150 properties and over multiple geographies. It could even be across different property types and it gets into the different ideas. So what would be a way to do that? Well, I would sell my property and I could go buy into a structure that owns 150 properties and own a little piece, right? And so one way one might think to do that is you could go sell your property, you get all the proceeds, and then you go there's publicly traded REITs, right? So you could go to buy the stock of a REIT, and in theory, that would be fantastic, right? I can go now I can buy into Avalon Bay, as an example of a very, very, very large REIT. I now own a very, very small fractional interest with my stock ownership. I'm entitled to all the dividends because REITs are required to pay out certain amounts of their cash flow out to shareholders, so they don't hold it and sort of like it's not like a tech startup where no money comes out. It's a dividend stream. You get those dividends. So I could do that, but here's the rub: the IRS rules. So the IRS has said, look, you can't 1031 exchange or you can't do on a tax deferred basis, sell your property and buy securities. You have to sell your property and you need to buy property. Okay. And the property dynamics are, are housed with definitions. And so we'll keep it relatively simple for this, but that's the rub. So if I sell a property and I go buy Avalon based stock, I will pay capital gains. I'll pay depreciation recapture, capital gains, federal and state, depending where you live. I may have a net investment income tax. And so now I've got a huge tax bill. So when I go reinvest into Avalon Bay stock, I'm investing 70% of the proceeds I got versus 100%. Okay, as a hypothetical. Well, there's a solution to that. So it's a so-called 721. They're also called UPREIT transactions, where you can actually swap from a real estate property into a pooled vehicle. Okay, and so what they do and what's allowed in these 721 transactions is, and often done with a private REIT, though for very, very large people, large investors, large portfolios, this does happen every once in a while at big public REITs. They could do it too. Doesn't mean they can't, but that's not sort of their game as much. But for smaller investors, there's really interesting structures out there with great managers who have a pool of investments, and large managers are all doing this. And I don't promote any one brand or another, but like very large institutional players. Yeah, I'll sort of, if people want to know names later, I'm happy to share ones that are sort of very large players are doing this, and they're making it available to what is sort of quote unquote retail customers. So an individual with their $4 million property, $3 or $4 million property in Los Angeles wants to sell. They've now made structures available where you can sell that property, and then in exchange for the property, you receive membership units at the REIT. Okay. And so there's a little bit of it sounds more complicated than it is, but these operating units that you get, okay, qualify for a like kind exchange. Or a tax deferred exchange of real estate. So you can go swap your property into a 721. And in fact, there's DST structures that are set up that you invest in the DST, you're involved with that for a bit, and then it swaps in and you roll into the bigger structure. And what does the bigger structure has? It has 150 properties like we wanted. We now own operating units in the entity. Those operating units, just to get into it, do have liquidity. Okay, so you can exchange generally those operating units for shares that the sponsor will buy back at a valuation that they establish. And so while I've been long-winded in this, I can take my individual property, I can swap into operating units of 150 property portfolio in this example, and now I can get dividends off of the 150 property portfolio. I've achieved the diversification I'm looking for, and it does provide me periodic liquidity, but it does come with a bunch of trade-offs. So that's a bit about the 721.
Well, just to make sure that I recap my understanding of it for the audience, the reason why the white paper from with the IRS for the DSTs was important is because it unlocked this ability where you don't have to be a solo owner or in some sort of limited partnership in something that you can go drive to and manage and operate. You're now at that level able to still 1031 exchange into something that has more partners, but it is that single asset when you're talking about a lot of these DSTs with the 721 exchange. We're now unlocking the ability to invest in stock, not real estate, but that's in a company that holds real estate as a real estate investment trust. So that's really the big difference. The bridge is now you can go from property to stock. It's still real estate associated, but you're no longer the owner of 150 properties. You're the owner of a company that owns 150.
Yeah, you're an owner of operating units inside of this broader entity that is entitled to a small fractional share commensurate with the value of the properties versus the value you contributed. And yeah, you've achieved huge diversification. Within these structures, they also offer liquidity, which is nice. So generally speaking, you can get periodic liquidity, which is relatively often where you can exchange your operating units, which is what you technically get, into REIT shares, and then they'll buy those back. The rub is that once you make this commitment, and these are the trade-offs, and not no, it's not a bad, it's not necessarily bad or good. It's just the nature of it is there's really no effective way to get out of those when you achieve, if you want liquidity, there's no effective way to get out of it without paying tax. So you're going to roll over your gains into this structure. So you're not going to pay any tax as you go into the structure. You'll get, if I have, if I have a $4 million property and I have an $800,000 tax bill that would normally be paid, I keep 4 million uh, in investment and dividends off of that, that come from the properties that are owned. But if I sell, or I attain liquidity inside of the structure, which most of them all offer, you will pay the tax at that point. You can't roll out into, you can't say, oh, I'll just sell my shares and go buy another property. You can't generally do that. So that is one of the trade-offs that folks have. It's also why folks who are a little bit later in their life, um, it serves them in particularly really well. Again, it can serve all cohorts, but it serves them particularly well because they get the diversification, they get more passive, they get professional management, and that includes professional reporting and accountability and all the different things that one would be looking for. And then ultimately, it depends. Now, under the new Trump tax bill, there's for a husband and wife, there's a $30 million estate tax exemption. So if you have a very large gain embedded in all this, and when your heirs inherit your assets, assuming you're underneath that limit, all your assets will step up to fair value for your heirs, your kids, and they could sell the next day and use the liquidity to sell and monetize, and there would never be any tax paid. So it's a huge opportunity in that respect.
Okay, a couple of things that I want to unpack, and we're just getting to know each other, Jeff, on a Zoom discussion. Um, for those that may not have heard this in the past, and for you, Jeff, I got my degree in finance, and you obviously have heavy education in accounting and finance and practical experience. Diversification for a lot of people, it just means we're spreading risk around. Instead of owning one asset, we're owning 10 or 150.
Yeah,
And so if one is up and one is down, you hope that the collective is a gain, not a loss. So that's one of the benefits of doing this is you're diversifying that risk. But why do we want to diversify that risk? Because that one owner did the opposite of that. They took a risk. All entrepreneurs are in the business of taking risks. And they bought one asset that did really well. And now they
right.
don't want to lose. They don't want to go backward. And they don't want to have that backslide. So that's some of the other benefit too, is you've got this they want to have obviously protection from taxes so that there's that erosion, but then also just they want to try to cover themselves from additional losses. Am I
Yeah.
sort of getting the concept there for everybody?
Total. I mean, you're getting into the entirety of portfolio management, and it's sort of if you're looking to get insanely wealthy, specify. If you're looking to build wealth, diversify. So it's sort of this, I don't know. It's just a little sort of saying the dynamic is volatility goes both ways. So if you own a singular property in a singular market, let's say it has very attractive dynamics that end up playing out. Maybe there's a big population inflow. Maybe there's big just demographic tailwinds that some areas enjoy. If you own one property there or even multiple properties in that one market, you will get huge benefits, right? And you will outpace a broader market who's wearing, as you said, some of the areas that are struggling. Maybe, some Rust Belt community that lost all its manufacturing base. I'm making up some scenario where now that community is struggling, or maybe you're in some some air you're in some more challenged areas that are seeing population outflows for various reasons, so housing's becoming more abundant, and so supply is outpacing demand. All those things can be very impactful. So yeah, folks generally speaking own, if you look overall, I mean, this is just for my mom too. You take my mom, I look at her portfolio because, I managed big portfolios for a while, and these very questions are the exact thing. How big are your positions? How concentrated do you want to be? What level of conviction do you have? What's your stage in life? How willing are you to take losses? Can you absorb the losses? Can your lifestyle handle this? These are the things that are all what wealth management portfolio managers need to all be asking either clients or be thinking about for their portfolio construction. generally speaking, and this includes my mom, and I told her this after we did a deep dive. I said, like, you are so long, meaning you have way too much real estate, right? And it's, just property she's owned in her surrounding community. She built up, a nest egg with my father. They bought and felt like it would be a good idea. They paid off the mortgage through time and did not. They were very tried and true way to invest. And real estate in general, just as a dynamic, and for your listeners, if you look at really long time series on real estate, and the last 30 years has been, or maybe even 40, has been a big skew, and which is what we've all been living in. But it outpaces inflation by like a little over 1%, period, as an asset class. If you go look, there's people who put together hundreds of years of time series. How they achieve that data 300 years back is for, I think, another discussion. Who knows how they're looking at, colonial times. But they put these time series together. I'm sure there's records and they, and so real estate in general is not a very volatile asset. It depends how much leverage you put on it. It could a very unvolatile asset with borrowings to do all the purchase becomes very volatile because your equity is really thin. So a very small change in the value creates huge changes in your ownership level. But in general, real estate is a pretty conservative investment in a very, very long time series perspective. And so people making that, and so that has generated, and in the last 50 years in particular, it's been a huge wealth generator, and people in general are doing it with borrowed money. So that's been a huge way to multiply the returns on it, right? Where most people with their stock portfolios are not margining all their stocks to go do it. And there's a bunch of reasons we could talk to you about why that happens. But the short of it is everybody's killed it with real estate, generally more over concentrated if you looked at it, but it also gets on how you construct it. So bringing it full circle to your question of, yeah, you're getting later in your life, you're more focused on your retirement dynamics, you're more focused on stable income. And let's just say you're somebody who really likes multifamily. Obviously, people need a place to live. It's a really tried and true, viewpoint. And if I have a portfolio that has Seattle, Chicago, New York, Miami, Dallas, Kansas City, and Phoenix exposure, the dynamics of where people move, how they move, microeconomic dynamics that do matter a lot. Like, they matter a lot. I can't overemphasize that you can't always foresee, get minimized, right? To your point. So if I really, really care about back to that $4 million dynamic, let's just say I have a dividend stream of, right, I'm going to say 10%. That's not really achievable. 5%, right? And so I'm getting 200 grand a year out of this. It's a nice retirement dynamic for me. I want to make sure the 200 grand stays there, right? And if I'm in a market that goes into a tailspin and now I can't rent a property, or maybe some massive single family rental REIT came in and bought up a ton of homes and they're cutting price because they care about occupancy different than me, I can get in a weird place where I don't have anybody renting it. I'm not getting the cash flow. I'm in this thing that has tons of properties. It has lots of unit count, occupancy, because let's just make something up. They've got, a few thousand units, right? In this portfolio, maybe it's got 15,000 units in it. Occupancy will only vary so much because it's diversified. You will get cash flow out of that. And also you need to be mindful of the leverage that they employ, but all of that works to your advantage. The other thing too is when you go into these structures, you aren't borrowing yourself. The structure is borrowing. So most of the time, borrowers who are individuals are guaranteeing all debt that they take on with their real estate. In these structures, you may have multiple assets in your portfolio. You may have a stock portfolio, a bond portfolio, a real estate portfolio, like my mom does. If she's in a structure like that and she wants to employ some leverage against the real estate, she thinks that optimizes some of the yield, I can do that non-recourse in a big structure also. So those are some of the big benefits that happen, and how as you get to 75 years old and you're thinking about, okay, like I need to lock in more that income stream that I've built out through, the savings I've done over the course of my lifetime, like that, it's huge. Okay. It is a huge deal.
Well, and pause for just a second. We just hit a point that I think is really very important. When you've got a lot of one thing, you inherently are risking and you're betting on that to work. And little analogy here, and I'll sort of go in the way back machine, sort of like biblical times or medieval times, whatever makes more sense for the listener. You're thinking about conquering something, or are you a fortress builder? Have you already conquered this area and now you're trying to build a fortress around the area? When you're storming a castle, you're probably doing it really strategically in one spot to gain access to the castle. My career coach has become a best-selling author, Hall of Fame speaker. He had a viral TED Talk. He was episode 100 of this podcast. His name's Rory Vaden. He coined a term called Sheehan's Wall. And the best way for someone who is building a personal brand, which is the topic that he helps people with the most at his company Brand Builders Group, is banging through the wall. You're not hitting in lots of different spots over time because you're not ever going to get concentration enough to break through. And we call that breakthrough moment or that breakthrough situation. But once you're through the wall, a lot of times people say, okay, I made this huge gain. I made this big hit. Now I'm in a spot where I'm trying to preserve and
Right.
I'm trying to create this fortress around it to protect it. And diversification, the reason why a hedge fund is called that is they're hedging their bets and making sure that they've got mechanisms to control risk. And I think for a lot of investors, you have to be thinking about this. If I did it this way and I made all of my wealth in real estate, but I'm in this point where I don't have the energy anymore, or I don't have the risk tolerance anymore, my lifestyle has changed. And we all know what that's like when you're 30 years
Yeah.
old, your risk tolerance is way different than when you're
Totally.
60 and then when you're 80 and you're thinking about different things in life. And so I thought about that, Jeff, as just kind of a bow to pull around it, that you've got to identify what phase of life are you in. Are you a conqueror? Are you trying to storm the castle and break through that wall? Or have you gotten to the point where you've already done that and now you're trying to build a fortress around this area that you've conquered? And
Yeah.
that's really important in my mind, is just identifying who you are in the first place. And you've done that with your mom and probably tons of other clients as you
Yeah, it's you're spot on. I think you described it perfectly. And it when you're younger, your fixed commitments are much smaller. Your ability to have something go wrong and have the time and wherewithal to pivot and what you're doing, how you're doing it, where you're focused, all those things. So I think what you said is totally right. And I just it is easy. There's always the water cooler talk, right? It's like, oh, did you hear, Sam over here is making, 13%, and like, it's so easy every month he just gets, or he made 62% returns IRR on a 2-year deal, and you're like, oh man, that sounds really interesting. Yield chasing is always really dangerous, and it's easy to do, and you can lose track of what you're trying to accomplish inside of your portfolio. I have a gentleman who I respect immensely in my career, sort of a mentor as well, and he's done really well for himself. He's in finance, and I was chatting with him and talking about what he's doing now, right? Because he's sort of retired from the fund business and he's just independently investing, and like you said, he's got his fortress. And I asked him, like, what's the hardest thing about how you invest now? Because he's doing it on his own, and just he's like, the hardest part is sticking to the discipline, because I see things that are amazing, like amazing, come across, and I do them, but I've gotten maniacal about my sizing. Like, I just, it's so tempting to go, okay, I've got X amount of dollars. I'm going to put 25% into this incredible idea, right? And Warren Buffett sort of famously has talked about, like, when you see the ultimate idea, concentration is what you should do. And I agree with that. Sometimes it's hard to recognize, and that's why he's the best, is like he knows it when he sees it better than others do. I would say I think I know when I see it, but I've been humbled enough in my career to know that, okay, you got it. You go, it's sort of like how card counters do things in blackjack. When the count's good, you bet more. When it doesn't feel like, when you see a great deal, and you know it's awesome, and you've got the right manager with the right track record, it makes sense that what they say they can make it can be made again, and you understand it. I always encourage everybody, you got to understand what you invest in. I just It doesn't mean you have to know every nuance of it, but you have to understand what it is. And then you go in on it and you do a little bit bigger sizing, right? Okay, I'm overweight this thing because I'm convicted on it. And then you just, where are you in your life? All those different parts. And that's the real interesting takeaway for me. And again, this mentor of mine has been really successful in his post fund years, but he's like, it just kills me because the ones that I want to go massively in on so commonly do awesome. Like this is like, would have been another game changer for my position and sort of my wealth position. And he's just like, but things change, and there could be mishandicappings or something, and just I can't wait. I'm unwilling to wake up and blow a hole in a portfolio, and that's just where he's at. Where and again, there's no perfect amount, there's no like right percentage, but it sort of gets into again, like you said, risk tolerance, stage in life, lifestyle, etc. So
One of my favorite descriptions of what you just shared, Jeff, is there's a very well-known author, happens to be from Colorado, wrote a book called Good to Great. His name's Jim Collins. I've had the blessing of seeing Jim Collins speak on a couple of occasions in person in a live audience. And you can go to Jim's website and see a lot of these topics, one of which in his big glossary of how he came up with a lot of his books is called Calibrated Line of Sight, which is an homage to our podcast. And the description that Jim gives the audience, and it's in his books, and it references the book that it's in when you go to his website, is when you're creating a calibrated line of sight, imagine a ship on the ocean approaching you, and you're like, that's the enemy. We gotta sink that ship. It's like the
yeah,
old school game Battleship. How do you do that? You've got a limited amount of gunpowder, and you can either throw all of your gunpowder in with one big cannonball. And what happens is oftentimes we all do this. That's an opportunity, whether it's to destroy the enemy or an opportunity to win for me, however you want to look at it. And I want to take all of that on an uncalibrated line of sight. And what ends up happening is that that cannonball sails over the ship or to the
yeah,
right or whatever direction, not hitting the ship. He said, but what if we took our smaller guns and we packed a little bit of gunpowder in there and started shooting bullets, not cannonballs? And we kept shooting until we hear ping the side of the enemy's ship. And then we have a calibrated line of sight from data driven testing,
yeah,
sizing, whatever terminology you want to use, modeling that situation. You go, okay, now it took me 5 bullets to hit the ship, but I've got a much better calibrated line of sight and angle. And then bam, you put all of that gunpowder into that one cannonball, and you hit and you sink the ship. And so that calibration, that learning oftentimes comes from surviving some of our greatest failures. You mentioned that
totally,
a couple minutes ago, that there are some investments where you're like, dang, and without naming people, without
no
naming
doubt.
specific situation, the way I wrap up a lot of my shows is I ask, what's the advice you wish you knew when you were 22? What's that advice you wish you knew when you were 22? And oftentimes it's an opportunity to mentor someone that might be listening that you don't know, you haven't met yet. But from your experience of being in the hedge fund world, obviously 1031 specialists is your new venture with
Yeah.
John, Jeff. But like if you had someone that was 30 years younger than you, and they came in and they said, I'm just getting started in this world, and what, Jeff, what should I do? What advice would you give that younger version of yourself?
Well, I'll take this question in sort of two spots. Like, what's the thing I knew more about? I wish someone emphasized to me, and then also just sort of your investment, like thoughts. So I did a lot of things, for the benefit of your audience. I did stuff all up and down the capital structure. So I invested in equity of deals. I do hybrid things that had equity upside, but also were in loan form also. So I do a lot of different structured investments. So how you think about the structure of how you invest became critically important so that I had degrees of freedom to win. So can I be wrong and still win? And my view, great investors, in my opinion, and I think people maybe underappreciate this. Great investors aren't people who hit 100%. And that's my personal view. Like, I'm sure there's people out there who hit 100% and, and kudos to them. But my view is, and this is where, and I think I've executed in my career is, can I make more than I lose on my winners versus my losers? And do I have more winners than losers? And if you're doing that, and again, it depends on the asset type, on what the weighting should be. Like if you're doing more conservative investments, it should be overwhelmingly winners. If it's got more volatility, there's room for like how it can be a little more evenly balanced. Right? Like if you can if you're playing, going back to my gambling example, the best sports gamblers, if they can hit it a mid 50s%, they are killing it, right? Because they're doing so many bets. And if they can have bigger weightings on the winners than smaller weightings on the losers and win 55% of the time, lose 45% of the time. That is insanely good. Okay. So as an example for one, or if you're doing more conservative investments, really safe stuff, you should win 99.9% of the time if it's really, really safe. So it depends on the calibration, but can you win more than you lose? And can you win more on the winners than you lose on the losers? And if that is the case, you have run into an incredible investor. And it took me a long time to arrive at my own conclusions about that. Okay. So and how I think about things, how I size things, because I am going to have losers. I certainly had losers. Most of my losers didn't end up being catastrophic failures because of how I structured things. I could work them out. I set myself up in positions to take control. If I was in equity positions, I would do things in particular to give myself the opportunity to go create some of my own successes. So that's one way in which we were doing that in the role I was in for a long time. The other thing I'd say is advice that I wish I was told, and I still don't execute to the level I try to, but it is amazing how much people want to help people out there. And there's been moments in my career and in my life where I've been on like blitzes of really trying to meet a lot of people and, for various reasons or things I'm trying to accomplish or things I'm trying to raise money for or pivots I wanted to make in my career or otherwise. Those relationships were so great to me along the way. And I try very hard now to utilize, even if it's just Excel, it's relatively easy to manage this, but just check in with people, and if you're not like the best salespeople never sell anything. Okay. You never feel like you're being sold. Like you and me, Kyle, right? We don't know each other much, but like for me, I always end calls on, hey, do you mind if we set up like a quarterly cadence? Just say hi. And if there's something really to talk about, we'll just check in. I'm curious how you're doing, what you're up to. Like I've learned about a lot about you in recently here now, Kyle, and I'm curious about the arc and how you're doing. And then ultimately what ends up happening. And so if someone could have told 25-year-old me that you have to keep track of these people and just check in with them. You never know the places people are going or where, your skill set, attitude, support, confidence, all of that will play into helping others. And that all comes around. And so if you can, by checking in with them, can you help them? And in turn, they might think about you. And it's in no specific way. And guess what? When it's in no specific way, it becomes in a specific way. And that because it occurs to them, you're on their mind, you're somebody they go, wow, I'll give you a last story just because it pertains to, and it gets back to my mom, okay? And for real estate brokers, I mean, it is super kudos to this broker who engaged with my mom. My mom was a part owner in a multifamily rental that had 25 units. She had it with several partners, and she had a broker who was really, really involved in the area, uncovered that she was an owner in the property and of a material amount. She's a material owner. This gentleman set it up to call her. He called her once a quarter with updates on what's going on in her area. Here's what I'm seeing around. Here's things I've been doing. Here's, what things you might be mindful of that's going on around your property that I'm seeing. He did that once a quarter for 6 years. And so, again, I don't think, and I've told the story a handful of times to people because to me, I'm sure there's the moms, you meet my mom, another woman or man, and in 2 quarters, he found himself in a deal. But just because she wasn't selling, that was sort of but she would always pick up his call. They forged a relationship. Okay. And guess what? There was a moment where my mom was finally selling. She didn't even consider anyone else. And this isn't like a sales talk of how to go sell as a broker. It's more my mom's forging a relationship with that person. And if that person's even smarter, which I don't know if he is continuing or not. It wouldn't surprise me if he is, given the nature of this guy's attitudes on relationships. But guess what? My mom probably knows other people in real estate. Why don't I call once a quarter to her again and just like keep in touch and go, hey, like, here's what's going on. Thanks again for that transaction. Takes you 5 minutes, you keep that relationship. So that's what I wish someone told me that actually is more meaningful than the first thing I mentioned is the relationships that you forge. It's amazing how people can be valuable to one another, and I'm always impressed by people's willingness to be unselfish and help others be successful and win. And it's what my goals are, for as I engage with somebody, say, can I provide value first? Can I be helpful to you? I'm doing 1031 specialists, and we're a qualified intermediary, and that's what we do professionally and how we earn a living, and we're building this firm, and we're really proud of it, and it's grown to be one of the bigger players in this industry. But it's also if someone has anything else they want to talk to me about, if you called and said, "Hey, like, do you have any buddies in these two arenas? Like, I'm trying to see if I can get something going in this way or that." I'd go, maybe I've got a guy in that and try and help you out. There's no real downside to that from my perspective. I don't view relationships as like proprietary to me, and if I can help someone, then that's great, right? And I think others are that way too. So that's the long-winded advice I would give somebody. And I mentor people from time to time, and that is my main one. And people every time, I mean, every time is an overstatement, but every time, and again, I don't execute to the level I wish I did, but every time they go, "Gosh, you're totally right." Like they just start thinking about their database, right? And they go, "Well, I don't know that many people." I'm like, "Yeah, you actually do. You just haven't really put it on paper." And then they go, "Oh man, yeah, you're right." Like so, it's very interesting, and it's something that I wish I leaned into earlier and try and focus on more now.
Jeff, that's one of the most poignant examples that you've shared with a huge piece of just success that I've experienced wrapped in that answer. A very quick anecdotal, this is how I built my career. At some point, I don't remember where I got the concept of do a quarterly newsletter, but at
Yeah.
some point in my 20s, as a young real estate broker in a geographic farm, is what a lot of residential agents call it, or just this was the area and the product or your specialization, which is a lot of people will describe it as. I started sending quarterly newsletters to about 700 people, and I did 52 of them. So quick math, that was 13 years of quarterly newsletters. I
Yeah.
wouldn't call every single person on the newsletter every quarter, but bang, bang, bang. I was doing those every
And it was
single
a touch point, right? It was a touch
touch
point with
point.
them. Yeah.
It was a lot of work, but it caused me to step back, think about my area, write about it. It was paper, literally fold it up, send it off. At one point,
Yeah.
my wife and my mother-in-law and I would spend a Saturday folding these 700 newsletters, mailing them. I then got to a point where I did an automated process with a mailing company, but I did that for 13 years. And why did
That's
I
awesome.
stop? Because I had gotten to a point where I became a specialist over that 13-year period, and people started calling me. That then translated into more digital marketing and things of that sort. But it was just that simple. I just stayed in touch with people on a quarterly basis. I wanted to scale it a bit. It was
Yeah.
hard to make phone calls like that, but that description of your mom and the real estate agent and how to do it and all
And
of
that
the,
is 100% true as an
yeah,
FYI. I was sort of blown away when I heard that. I was like, wow, like that guy, good for him. He's earned that business for sure. And if he's doing this for that long with this type of investor in this type of market where he's that focused and he's doing it 6 years, like you've got so much circumstantial evidence to say that this is somebody I can work with. Yeah, I totally support it. 'Cause she's like, "Oh, are you cool? Like, what do you think about me going with this gentleman?" As she's thinking about it, just looking for general advice. I said, "I think this guy sounds amazing, and you like him, you built trust, like perfect, right?" So, yeah,
Jeff, this is a huge investment in your time. Seriously, spending an hour with someone as we're prepping and then being interviewed, plus you're on the hot seat. I'm so grateful for that. The website is beautiful. It's
Oh, thank you.
fantastic. It's really informative. Your partner John spoke about it at length. So this is just a great, and if you're listening to Jeff's episode, it's going to be ranked right above John's because of the order of things. So all you have to do is just continue listening. But Jeff, I'm going to give 1031 specialist, that's with an S at the end.com, a plug. And then the phone number, if you need more detailed strategic advice, 631 438 1031. But talk just briefly about the AI infused data engine here. I know John spoke about it a lot, but I just did a quick little question and in 45 seconds, can you tell people why they should just do a search term on your website and what benefits they'll get from it?
Totally. And this gets into the niche nature of 1031 exchanges. So we are a service provider to investors who are doing 1031 exchanges. If you want to do a 1031 exchange, you have to hire a qualified intermediary like us. And our view is that we should be at top of your list. And so part of what we built was, hey, is broad-based information that you can search using ChatGPT or other broad-based AIs, does it give you right answers? If it does, we're not going to go build something that already exists. It does not, is the short of it, right? The more and more niche you go, the more you risk that it deviates. So we built our own AI engine on our website. I have been around 1031 exchanges my whole life. My father's tax attorney, brother's tax attorney. I've been around tax. I'm a CPA by background. So like been around a long time. I ask the questions of our website as I'm answering clients' questions just to see and it is remarkably good. So we built a purpose-built AI engine on our website to answer 1031 exchange questions, and you can give it really any kind of question. You can bring in state dynamics. You can bring in it's dealing with all the code, all the supplemental guidance, and it's all in one spot. And again, I use it every day as I answer questions just to see. And most of the time, it's just, oh look, there's a thing I should have probably mentioned that it didn't like really occur to me off the top of my brain to say, and just a little extra nuance because I'm pretty well versed in this myself. But it's also so for everybody who's wanting to ask it questions, it's insanely good. Like it is really good. And for pretty much any question you would have, it's going to give you a very good answer. Obviously, it's not meant to replace your CPA or attorney as you get into a total structuring dynamic, but it's going to get you the right answers for the questions you have, truthfully. So I'm really proud of it, and John's I know is really proud of it, and so it's a core part of our website and how we try and lead with value for our customers. We don't charge for it. You can call us up if you have questions. We don't charge for that. Like it's just we try and provide value to our customers. And the idea is that when folks are going to exchange, they'll think of us, and lead with value is always a philosophy I have, and that's what we try and do there.
Jeff, thank you for your time. Thank you for the answer.
Thank
It
you.
just reminds me there's so many situations in academia. If you've been to seventh grade or you've gotten a master's in something, there's always that professor, that teacher that says, raise your hand. There's no stupid question out there. And inevitably, every single one of us goes, I don't want to be the person who asks a stupid question. And someone asks a question because they need knowledge on a subject. And you got, Bruno in the back that's giggling. He's a fifth year senior because he's having to take the course again. And you're like, no one wants to have Bruno make fun of me. This is an opportunity where you can type anonymously. You don't have to sign in. You type and you get an answer. It's going to build it and you have learning right away. So for those of you that want to learn more about the topic, I swear go there. What I'm going to do as a gift for the person that listens, in the show notes, I asked at the beginning of the show, I didn't tell you this, Jeff, but I asked the bot, which has John's lovely face as the picture there, how is a 721 exchange different from a 1031 exchange? And I got one, two, three, four paragraphs, not long paragraphs, but easy to read. I had to scroll once to get to the full thing. I'm going to drop that there and give the answer. And it's the answer that we just talked about over the course of about 50 minutes. And so happy, so grateful, Jeff. Thanks for joining Calibrate. We're a real estate podcast. If you have questions for us, go ahead and send an email to info@Calibrate RE. Most of the topics that people want to know are in that library. So for Jeff Bemis, for his partner, John Hilly, who I had on the last episode, I'm Kyle Malnati. I love to say this. We will see you around the neighborhood. Thanks for
Thanks,
listening.
Kyle.
Thanks for tuning in.